Hi, welcome to Financial Education for the Nation. My name's Warren Shute, and I'm here today on my own. Paul is not going to be with us today. He's not feeling too great. So I thought I'd give you an update on what the markets are doing, because yesterday we had a bit of a volatile day in the stock market. The FTSE was down quite low. The US market was down as well. And I just kind of want to bring a bit of context behind it and share with you some figures. I'm going to keep it very light, very easy going. But just want to share a bit of information with you to hopefully give you a better indication of how things are going out there. Okay, so hopefully you can see my screen now, and basically what you can see on there is the FTSE 100. Let me change this pointer here so you can see a little bit better. Spotlight here. Okay, so this top line here shows the FTSE 100, which is the 100 largest companies in the UK, and then this is the year-to-date return. The 1 month, 3 months, 6 months, a year return, 2, 3, 4, and so on as you go out. We can just park this information for the time being. And these are a yearly return. So over a 10-year period, the FTSE 100 has averaged just over 9%. And then the second row here is a typical portfolio that we would run in our office. It is a very similar sort of risk level, slightly lower risk to be fair. This is a measure of risk. This is 15. As a standard deviation, this is just over 11.5, so it's quite a bit lower risk, but essentially there are similar portfolios. So we got a lot of red here at the beginning. So as you can see, the start of this year, and this year itself hasn't been particularly great. We're pretty much flat on the year, but as you look over the longer term period, the returns haven't been too bad. Now, I can't change it with that, so I just need to go back and change it to the mouse. Okay, but those returns are caught up with all this noise. This is noise. These are monthly returns, and you can see that some months we're up, some months we're down, some months we're up, some months we're down. And this is how the stock market works. It goes up and down, based on short-term movements of news, typically of what's going on, whether it's good news, bad news. And it's bad news, they think it's bad news, then they digest the information, and then it becomes good news. And it's happened all the way since times began. Now, this chart goes back to 1994, so we're about 97 at the moment. You can see there's a big drop there in 98. Okay, but then it returned the next month. Literally, you've got quite big returns here, coming down 99. You can see the 2000 correction here, but actually that was 1 month. Straight after that, things sort of seemed to come back together again. But it's happened all the time, just constantly happens. If we look at 2007, 2008, around about November 2007, it was the Northern Rock correction, Northern Rock crisis. And you can see just happening all the way through, and it's happened up until the present day as well, okay? So these are monthly discrete returns in the market. So the dark blue is the stock market of FTSE 100, and the green line is a portfolio that you would operate. They go up and down, and that's what it is. It's those ups and downs that create this. This is what you're most used to seeing. This is the long-term return to the market. And you can see from starting at a base point of 1, the FTSE here is up about 5 times over this period, and our portfolio is up 7. Now, that's not because we're fantastic. It's just the way it's constituted. It's a globally diversified portfolio. And the outcome of this isn't to say to you how wonderful the portfolios are, but just to say to you is you will see the ups and downs in the market, and it is just impossible to say what's next. You know, it really is impossible to say what's next. And this next chart, which I'm going to show you here, this next table here, hopefully you can see it now, is what we call in the business a quilt work patch. I think that's right. Patchwork quilt. That's it, a patchwork quilt, I'm sorry. And you can see the complete randomness of the return. So this is on this side of the screen, I'd say it's the left side of the screen, whereas the darker colors are the developed stock markets. On the other side of the screen, the more reds, is the emerging markets. Okay, and what you have is each individual country defined by a color, and if they do well, they're at the top of the chart, and if they do poorly, they're at the bottom of the chart. And a good example here would be something like New Zealand. You say, okay, we've got New Zealand here, giving us 2 great returns. Right, let's pile into New Zealand, because that's where the money is. Okay, well, New Zealand's dropping down. Oh, it's dropped down. Whoa, it's dropped right down. Oh, it's dropped down even further. Okay, and in fact, New Zealand's right down here just a couple of years later. That is a completely random return. You can't predict it. But what we can say, based on the chart, is over time, the stock market as a whole goes up. But over discrete periods, it's up and down, up and down. What we don't try to do is predict what's going on in the market. And at the moment, we've seen a bit of a fall. And this year hasn't been a great period of time. But that's just 1 year based on an experience of investing. And what you really need to do is make sure when you're investing for the longer term and not getting caught up with these short-term movements, because these short-term movements make up these short-term trends here, but not the overall movement of the stock market as a whole. And this final chart that I've got for you here basically shows the best and the worst returns over these periods. And again, the same blue line is the FTSE 100, and the green line is the portfolio that we have in our office, or one of the portfolios, and the bar in the middle is the average. But looking at the table below, you can see that over a 12-month period, just in 1 year, the worst return is minus 32%, but the best return is 50%. And that's the date in which it happened. Now, that's a massive variant there. But as you go on in time, this is the cumulative annualized return. So over a rolling 10-year period, what's the worst 1 year period? And what's the best 1 year period? Okay, and then over 20 years, you can see how they sort of fade into more positive returns, or move, should I say, into more positive returns. So I think the message that I'd like to leave you with this is markets go up, markets go down, bad news sells. You tend to hear a lot of information from it. What you need to bear in mind is when you invest, let's invest for the long term. That's 5 to 7 years at least or more. Don't take more risk than you feel comfortable with. And if you're in the stock market, make sure that you're diluting that risk with more high quality short-term bonds or cash. Folks, that's all I've got time for you today. That's really pretty much what I wanted to share with you. So hopefully it's been interesting. Hopefully it's been helpful for you to see that. And I will catch you again next week. Thank you very much.